Hey everyone, welcome back to Mind Your Money Monday. Before we dive in, quick question. Have you ever saved up any money for something big and felt proud seeing that balance grow in your account? Maybe you've been stacking cash in Venmo or a friend sent you some money and it's just sitting there. It feels good, doesn't it? Well, if you're planning to buy a house, that money might actually be working against you. And I know it sounds crazy, but stick with me for the next few minutes because I'm going to explain why that $10,000 in your Venmo account could be a massive red flag to your mortgage lender. So today we're going to talk about something that trips up first-time home buyers all the time. That's down payment sourcing and seasoning requirements. These are rules that seem designed to frustrate you, but they exist for good reasons. And by the time we get to the end of this video, you'll know exactly how to handle your money so you don't blow your home purchase at the last minute. I'm Sabria Callis. If you're new here, welcome. Your partner in finding and funding your new home, helping renters and first-time home buyers turn their dream of home ownership into reality. Let me tell you a little story about Brenda. Now, Brenda's a real person. I know her, but her name has been changed for the sake of this story. And she learned this lesson the hard way. She had been saving for 2.5 years to buy her first home. She was diligent, disciplined. I'm talking about putting away $500 every month. She had finally hit her goal. $25,000 was saved up. But here's where things went sideways for Brenda. Brenda kept her down payment in three different places. About $10,000 was in her regular savings account. Another $10,000 was in a Venmo account because she had been collecting rent from her roommate, and $5,000 in cash that her grandmother had given her as a gift, which she deposited just 2 weeks before applying for her mortgage. Now, Brenda had found her dream townhome. She made an offer, she got accepted, and then started the mortgage application process, feeling super confident. Then she got that phone call from her loan officer. Brenda, we have a problem. The lender wanted to see 2 months of bank statements, which is standard, you guys. But when they looked at her accounts, they saw that big $5,000 deposit from 2 weeks ago. That was some red flags that started to flare. Red flag number one, they asked about the Venmo account. Where did the $10,000 actually come from? Was it gift money? Was it from a side business? Were those deposits income that she just didn't report? And red flag number two, here's what Brenda didn't understand is that lenders don't just care that you have the money. They need to know where it came from, and they need to see that it's been sitting still for a while in your account. Now, Brenda's closing got delayed by 3 weeks while she kind of scrambled to document everything. The seller almost walked away. She nearly lost the home because she just didn't understand these two crucial concepts: sourcing and seasoning. So let's break this down. First up is sourcing. Sourcing means proving where the down payment money came from. Lenders need to verify that your down payment is coming from a legitimate source and that you're not secretly borrowing money, which can affect your debt to income ratio. Now, when you apply for a mortgage, you're going to need to provide typically 2 to 3 months of bank statements for any account that you're using for your down payment. Now, the underwriter is going to look at every single deposit in those statements. And I mean, every single deposit. Any deposit that's larger than a certain threshold, usually around 25% of your monthly income, or sometimes just a deposit over $500, is going to get flagged. You'll need to provide a paper trail showing where that money came from. Now, there are some acceptable sources, and they may include your regular paycheck deposits, any verified gift money from family members with a gift letter, money from the sale of assets like a car or stocks, tax refunds, bonus checks from your employer. What raised the red flag um, could be cash deposits with no clear sources, transfer from people who aren't your family members, money just that absolutely showed up without any explanation, and then loans from friends or any undocumented sources. Now, business income that didn't match your tax returns and it showed up, that could be a red flag. This is why Brenda's grandmother's gift was a problem. The money was legitimate, but Brenda needed a signed gift letter from her grandmother stating that it was a gift, not a loan, and that no repayment was expected. She also needed to show that it had come from her grandmother's account directly, not as cash that Brenda had actually deposited. Now, the Venmo situation was even trickier. Those roommate payments looked like income, which she had been should have been reported on her taxes. Brenda had to prove that these were reimbursements for rent that she was paying, not unreported rental income from a property that she had owned. Now, let's talk about seasoning. No, we're not talking about cooking here. In mortgage terms, seasoning means your money needs to have sitting in your account for a specific period of time, typically 60 days or more. Now, think of it this way. Lenders want to see that that money in your account really is your money, not something you borrowed yesterday and plan to give back tomorrow. Seasoned funds, they have a history. They've been in your account long enough to prove that they're stable and they're legitimate. This is why financial advisors tell people who are planning to buy a home, stop moving money around, right? Find a place, identify that account. If you're 6 months away from applying for a mortgage, put your down payment money in one or two accounts and leave it there. Let it season, y'all. Now, here's what can cause seasoning problems. Just like sourcing, seasoning has its problems. Large recent deposits. If you're depositing a big chunk of money right before applying for your mortgage, even if it's your own money from another account, you'll need to document it, where it came from, the statements from the original account is going to be needing. That account hopping, moving money around between Venmo, PayPal, Cash App, your bank account, it's going to create a complicated paper trail. So each transfer needs documentation. Now, those cash deposits, these are the worst. If you've been keeping your money under your mattress and deposit it, lenders get very, very nervous. They can't verify from where that cash came from. The gift money timing. If grandma wants to help you with your down payment, that money needs to be deposited and seasoned, or she'll need to provide extensive documentation, including the gift letter and her bank statement showing that she had the funds. The golden rule is 60 days before you plan to start house hunting. Seriously, get all the down payment money into one or two traditional accounts and don't touch it except for your normal living expenses. All right, so how do you actually do this right? Let me give you a game plan. Step one, I want you to plan ahead at least 3 months before you want to buy. Consolidate your down payment funds into a regular checking or savings account at a traditional bank or credit union. Not Venmo, not Cash App, a real bank with statements and FDIC insurance. Step two, document everything. Keep records of where that money comes from. If you're transferring money from different accounts that you actually own, keep those statements. If you sell something to raise cash, keep the bill of sale. If someone gives you a gift, give you gift funds, get that gift letter signed immediately. Step three, minimize any cash transactions. If you've paid in cash for workside work, deposit it regularly in small amounts and keep records of the work that you did. Large irregular cash deposits that get scrutinized heavily. Step four, keep your money still. No bouncing around, no hopping around. Once it's in your designated down payment account, resist the urge to move it around. Let it sit there and season. I know it's tempting to chase a better interest rate at another bank, but that transfer will create some paperwork headaches. Step five, talk to your loan officer early. Before you start house hunting, have a conversation with the mortgage professional. Show them your financial situation. Ask them if they see any red flags. It's much easier to fix problems before you're under contract on a house. Step six, Keep your spending normal. Don't suddenly start changing your financial behavior. If you normally spend $200 a month on groceries, don't suddenly spend $1,000. Unusual activity is going to trigger some questions. Here's something to remember. If you're getting gift money from a family member, there are two ways to handle it. Option number one, have them give it to you early, let it season in your account with proper documentation. Option number two, which is often the most easiest, have them send the gift money directly to the closing attorney or escrow company at closing. This way, it never touches your account and the documentation is so much more simpler. Now, what if you're watching this and you're thinking about mistakes? Oh my God, I've already made some of these mistakes. Don't panic. These issues are fixable, but they require documentation and potentially delays. So be upfront with your loan officer immediately. The earlier they know about complicated deposits or money movement, the earlier they can tell you what type of documentation that you're going to need. You might need to provide just a few things. Statements, again, from the multiple accounts showing the money trail. Another thing that you might need to provide is letters of explanation for unusual deposits. Again, gift letters from family members if any gift funds are received, proof of sale for assets that you sold, business records if you're self-employed. In some cases, if the documentation is too complicated or it's impossible to obtain, you might need to wait longer before applying for your mortgage, letting that problematic deposit fall outside of the required statement period. And yes, this might mean delaying your home purchase, but it's better than having your loan denied mid-process, getting tied to the home that you really like in that desired area. Look, I get it. These rules feel invasive and annoying. You're thinking, I need to prove where it came from. It's my money. Why do I have to do so? But here's the thing, the mortgage industry learned hard lessons from the 2008 financial crisis. People were getting loans they couldn't afford, using money they didn't really have. These sourcing and seasoning requirements exist to protect both you and the lender from making a bad decision. That's what this is all about. We want you to stay in the house once you decide on the house. The bottom line is simple, you guys. If you're planning to buy a home in the next year, I want you to treat your down payment money like it's already under a microscope, because it will be. Sometimes the process can be brutal. So keep it in traditional bank accounts, keep it still, document everything. And if you have money sitting in Venmo, Cash App, or PayPal, I'm gonna need you to move it now. Get it into a real bank account and let it season there, because your future self standing at the closing table is gonna thank you. And if this video has helped you in any way, give it a thumbs up, subscribe for more real estate and personal finance tips. Drop a comment if you have questions about your specific situation, and I'll do my best to point you in the right direction. Again, thanks for watching, and I'll see you on the next video. Bye now.